Good afternoon and welcome to the Munro Climate Change Leaders webinar. My name is Taylor Bree and I'm the Communications Manager here at Munro Partners. Firstly, we'd like to say thank you for taking the time out today to dial in and hear about our fund that is focused on enabling the decarbonisation of the planet. The Munro Climate Change Leaders Fund was launched in October 2021 and is now available on the ASX under the ticker code MCCL. Today, I am joined by Nick Griffin and James Tsinidis, who are the co-leads of our climate fund. Hi guys, how are you both?
Good, thanks Taylor. Thanks for having us.
Thanks.
The format for today's webinar will be a short introduction on the case for climate, as well as a deep dive into the 4 sub-areas of interest of the portfolio. And then the remainder will be a Q&A session. So we encourage our audience to submit any questions they may have via the Q&A button at the bottom of your screen. We'll also be joined by our responsible investment manager, Mike Harut, who will be able to answer any of your ESG and responsible investment questions. Today's webinar is obviously about our climate fund, but if you wish to hear about our other funds or missed our last webinar, the February update is on our website and YouTube channel. And so with that, Nick and James, do you want to kick us off?
Yeah, thanks very much, Taylor, and thanks very much everyone for dialing in today. So today, as Taylor said, we're going to be talking about our Climate Leaders Fund. Look, we understand it is obviously a difficult time in the world right now. It's a difficult time when you see what's happening in Europe, and obviously there's floods across the east coast of Australia, which are causing a lot of devastation. And so these are, difficult things to see. But today the message is going to be unashamedly positive. We are very excited about this opportunity. We are growth managers, and hopefully when we get to the end of this presentation, you'll see why we're as excited about this opportunity and hopefully you'll be as excited as we are. And as we look through these difficult periods, we think that this will slowly come to light in the months and years ahead. So just to begin with, I just want to take a little bit of time for everyone to read the disclaimer. I understand this is a retail presentation, and I want to be very clear that we are not offering advice here. We are talking about our products, and so please take the time to look at that, and we do not want anything to be solicited as advice to buy any of the one or particular stocks that we talk about today. The second thing I just maybe touch on really quickly for people who maybe are new to Munro, I'll just give a very quick introduction to the business as to who we are and what we do. So Munro Partners is a global equity manager. We're based here in Melbourne, Australia, and we are a growth equity manager. So unfortunately, we are unashamedly glass half full. As growth equity managers, we very much are thinking about how the world could change and what the opportunities are. That's what we've been doing now for 5 years at Munro and 10 years prior to that. The business was established in July 2016. We have a double-digit return track record for our core products here. We had a double-digit return track record at our 10 years previously at another firm. And we run just under $6 billion in assets under management today. And across the team today, the business has built dramatically in the last 5 years. This is just a quick snapshot of the team as it sits here today. The one thing you should know about Munro Partners is it is a partnership in the true sense of the word. So we own and control 75% of our business. And there are 9 partners on that page. And it is our sincere hope that there'll be more partners that join Munro in the future. And so everybody is aligned on the profit share of the business, and the profit share of the business is how successful we are for our clients. And so we do align ourselves with our goals, and that's very much at the foundation of what our business is about. Just moving very quickly through before we talk about the climate stuff, just to maybe just remind people what we mean by a growth equity manager. And what we've been doing now for 15 years in our investment process is that we unashamedly focus on earnings growth. Earnings growth is our North Star. And so what this slide is just trying to show you is the sort of stuff that we care about and the sort of stuff we don't care about. And so we have this simple philosophy that earnings growth drives stock prices. So if a company makes more money every year, we generally find its share price goes up. Sustained earnings growth is worth more than cyclical earnings growth. And our simple trick is the market often misprices growth and its sustainability. We've shown these same 2 stocks now for 5 years. One's Bank of America, one's MasterCard. What we're just saying is there's a structural shift occurring between cash and card, which is creating this structural growth trend for MasterCard. Bank of America is simply just a macro company. And yes, it will move around with the economy, but it doesn't really, we don't have a strong view on the economy. We're ultimately looking for these big structural growth trends. That's what we're doing. That's what we've done for 15 years. That's what we're doing in our main products. And that's obviously what the climate products is about as well, because we think this is going to be a huge structural change. And we're really looking forward to telling you about it today. How we've done this for the best part of 15 years is we've essentially taken the global equity universe and said there's roughly 30,000 companies in the world. We have no hope of covering them all. There's a whole bunch that profess to grow. And what we've been doing for the last 15 years is just really focusing on these structurally growing equities, the companies that can grow regardless of the cycle. There's a big change occurring, be it digitalization, cloud computing, e-commerce, that is driving this huge structural change. And we split them into these areas of interest or themes, whether it's healthcare, e-commerce, as I said, or climate change. And this is what we've done for 15 years, but what we're here to talk to you about today is we are setting up our first standalone, I suppose, satellite product or first standalone thematic product, which is the Munro Climate Leaders Fund and the Climate Change Leaders Funds. And in this case, we're literally just building a fund that focuses on one of these AOIs. And so you should very much think of it as a thematic fund, because we think this is the big change that's about to occur in the next 30 years. And so it was the obvious one for us to set up a standalone fund on. The last thing I'd say here is lots of people have asked us, why have you chosen climate? Why have you chosen climate? Are you just jumping on the trend, etc.? We have actually looked at these companies since 2005. It's been part of our universe since 2005. And also, if I could go back to 2005, back then I probably would have set up an internet fund, because a standalone internet fund would have done really well. It drove up, digitalization has pretty much driven our performance for the last 15 years. But when I sit here today, decarbonisation is clearly the next big opportunity. And so clearly when we wanted to set up a standalone thematic fund, climate was the first one we chose. Why do we choose climate? Because we're right at the start of this opportunity, and that's why we think it's such an exciting time. So lastly, just by way of introduction, these are the three funds that are available today that follow our growth process here at Munro. Most people would know our Munro Global Growth Fund. So this is the absolute return product we have. It's listed on the Australian Stock Exchange under the code MAET. And it is our absolute return global equity fund. And it goes across all those different themes, be it cloud computing, be it e-commerce, and also climate. We also have the long only version of the same thing, which is the Munro Concentrated Global Growth Fund under the code MCGG. That is just a long open version of the same thing. So it's slightly more volatile than our absolute return product, but it is a core global equity product. And the one we're here to talk to you about today is the Climate Fund. And in this case, it's very much a satellite product. It's a thematic product for people who think this is as big an opportunity as we do, and also for people who think that they would like to allocate capital here. Here, we're literally going to be going only 15 to 25 positions. So 15 to 25 companies in the fund. It's going to be a long only fund, so it's going to be fully invested all the time. It is going to be more volatile in the market. But you should really look at it as something to compete against, or an active version of something that competes against the ETFs in the marketplace. We do see a lot of ETFs in the marketplace. They generally have 100 or up to 100 companies in them, and they sort of put in anything that they think might be exposed to decarbonisation. And what we're saying is that we're active managers, and we can give you a much more concentrated product that will help prosecute this great decarbonisation opportunity. And this is listed, as Taylor said at the start, under the code MCCL. And that's the one we're about to talk about today. So the Munro Climate Change Leaders Fund is really a portfolio of structural climate winners that will help enable the decarbonisation of the planet. And with enabler being the key word. So if you believe, like us, that decarbonisation is here to stay, and we'll talk about that in a second, and it's going to last 30 years, then the companies that enable that decarbonisation should be structurally growing companies. They should be pretty good investments. And so from that point of view, that's what we're trying to prosecute here. Why do we think the time is now? The time is now is because, I mean, you don't need to turn on your television to see what the problems are in the world, and you've obviously seen it across COP24, etc. We have to somehow stop the planet heating by more than 1.5 degrees over the next 30 years. As we are currently sitting today, we are on a trajectory for a 3-degree rise. This current trajectory is where carbon emissions are going to go. And this is what we have to do to get it to a 1.5-degree rise. And so you're going to need to see a significant acceleration in decarbonisation investments in the next 30 years to hit these targets that everybody is looking to do. The last thing we'd also say is and you're starting to see this come to the surface right now, is over time, people are going to start to realize that while, yes, it's going to be very expensive to hit these decarbonisation targets, it's going to be less expensive than not hitting them. Because if you don't hit them, you're going to end up with natural disaster after natural disaster after natural disaster. And so from that point of view, we think very much at this tipping point of whereby we will accelerate this decarbonisation agenda. And that's not just because of this slide, it's also because of this slide. Because the acceleration of the climate agenda is not just being driven by government policy. It's being driven by everyday investors like the people who've dialed into this webinar. And it's been driven by your superannuation fund that is subscribing to these IGCC targets, or the investor group on climate change, or the Climate Action 100. So every single major investor in the world is pulling ESG into what they do. And every single major investor in the world is essentially looking to invest in net zero carbon portfolios. What that is forcing is every company in the world to effectively set a net zero target. And these are just some of the logos. You actually have $25 trillion of market cap now that have signed up to the Task Force for Climate Change Reporting. And so from that point of view, we are now seeing these companies producing sustainability reports. You can go to BHP's website. You can find the sustainability report. And in there, they are documenting how they plan to get to net zero by 2050. And it is being audited by EY. And so this huge shift that we're seeing from the corporate landscape is ultimately going to drive the decarbonisation agenda. On top of that, you've also obviously got COP26 that we just had. We're now going to have these every year, COP27. So we can really just keep track of how, as a planet, we're going to get to that 1.5 degree target. And it's, as I said, it's permeating both countries, corporates, consumers, and investors. And so ultimately that tipping point, in our opinion, has been reached. And so what that means, quite simply, is that we are going to attempt to decarbonise the planet. And so from that point of view, we've seen a lot of estimates out there. We think it's a $50 trillion expense to decarbonise the planet. We've seen expenses as high as $100 trillion. And so what we've tried to do at Munro Partners with this product is basically identify the companies that are going to benefit from this spending. Because the $50 trillion that we have to spend to decarbonise the planet is ultimately a $50 trillion revenue opportunity for the companies that help enable that decarbonisation. And that's effectively the idea behind the fund. And what you can see here on this slide is it's a very broad opportunity. It's not just electric cars. And so to help us break down that broad opportunity and how we've constructed the fund, I'm going to introduce James, who's the co-lead on this product.
Hi, everyone. Thanks for your time. Thanks for the intro there, Nick. Some of you might have noticed my light just came on and off. That's the smart sensor in our office. And that type of technology plays into actually the biggest part of the opportunity that we see here, which is this energy efficiency piece, which is 24% of the 50 trillion in spend that we'd expect to occur over the next 30 years. So that's the biggest piece of the pie, is actually just using what we have more effectively today. So that's energy efficiency of lighting in buildings like the one that we're in right now. It's the heating and cooling of the buildings, it's insulation, etc. So those are the type of opportunities we're looking at there. Next biggest piece is the renewables. So that's obviously going from a fossil fuel-based electricity grid to renewable energy, primarily wind and solar. Biggest piece after that's passenger EV, which we'll talk about today as well. You can see batteries, hydrogen. Basically, a lot of this is going to touch every part of the economy. So and touch everybody's day-to-day lives. So on the next slide here, we've just got a stylized version of where we expect that 50 trillion to be spent. And this is how we're going to capture the opportunity and set up our universe of companies, or how we have set up our universe of companies. So in the top left-hand corner, we've got the clean energy companies. So that's the 18% of spend we just showed on the slide before. So here we have companies like NG.Air Energy, which we'll talk about in a minute. We have companies like RWE, which is a major utility in Europe. Top right-hand side, we've got the energy efficiency companies. So that's the companies that build the type of technology that just turned my light on and off when I didn't move for 5 minutes. It's insulation companies like Kingspan in Ireland that help us basically keep our homes and offices warm without using as much power to heat them. Bottom right-hand corner, we've got the clean transport. That's again 18% of the pie of where we expect the money to be spent. And here you have Tesla, but a lot of the suppliers into Tesla and EV cars as well. Bottom left-hand corner is a bit of a mix of businesses, but we're terming this the circular economy. So this is companies that are involved in collecting trash, recycling, reducing the use of plastic, recycling plastic, better use of agricultural equipment and so forth. So we might talk about that as well in Q&A, but that's basically the 4 key areas that we're looking to invest across for this fund. And maybe Nick, if you just slide one forward. This is basically the exposure to each of those subsectors in the fund today. So we did initially think that we'd have a relatively equal balance between the 4, but we will pivot through time because different areas will do better in different environments. So at the moment, we're in a bit more of a defensive environment. So we have more circular economy stocks, trash companies, packaging companies, etc., that will hold up better in these types of environments. Similar with the clean energy stocks. We have in here a few more of the renewable developers and utility companies. And again, they're going to be lower volatility stocks for the environment we're in today. The energy efficiency is a bit more cyclical. It's a bit more levered to buildings and renovations and so forth. And so that's sitting lower in the fund today, but we do see a good opportunity there for structural growth companies like Train Technologies, where they're involved in heating and cooling and ventilation in buildings and retrofitting buildings like the one that we're in. And then the last piece is just the clean transport piece. So this is one that Nick will touch on in a second. But that's the 4 key sub-segments of the fund. As Nick mentioned, we've been covering these type of stocks for 15 years. And we see a good mix of opportunities across the whole climate angle to capture that sort of $50 trillion worth of spend over the next 30 years. Just on the next slide, this is how the fund's set up in a more traditional sense, so by regions and by sectors. And you'll see on the left-hand side, there's quite a lot of exposure to Europe. So a lot of the green champions are actually coming out of Europe, and we can probably talk about why that is as we go along. But yeah, a lot of European exposure. And then on the right-hand side, you can see the sector exposure. Relative to our other funds like the Munro Global Growth Fund and the Munro Concentrated Fund, which tend to have a bit more exposure to tech and these sort of high growth type of sectors. This fund's a bit different. It's got a lot more industrial exposure and utility exposure. And that's because it's industrial companies that build this type of technology that we're looking for to decarbonise. And the utilities are obviously the ones that are developing a lot of the clean energy as well. So it's a little bit of a different sort of regional and sector makeup from our other products. What we might do now is actually just go through a couple of the sub-segments and just take you through our thinking here. So the first one here is clean energy. I'll take you through this one, and I'll hand over to Nick to go through the clean transport side. So first thing we'd say about clean energy is it's going to take share from fossil fuels. I think that's pretty obvious. But electricity is only 20% of energy consumption today. It needs to go to 50%. Within that, obviously, we need to move from fossil fuel-based electricity to renewables. And that's going to drive renewable growth for a very long period of time. Maybe, Nick, if you go to the next slide, I can just show that here on the chart. So this is just some data from the biggest renewables developer in the world, and it's NextEra. So that they're expecting renewables to basically grow 20x over the next 30 years. If anything, that's going to accelerate now with some of the issues that we're seeing in the world in Ukraine and Russia and so forth. So 20x growth, and within those bars, you can see where that's going to come from. So you can see solar and onshore wind today are the predominant parts of the renewables development, but that's going to increase out to other areas as well, including offshore wind, which is just at the early stages and is going to take off as well. Down at the bottom there, we show some of the companies that are set to benefit. So we talked about NextEra; they're already the biggest in the world. Vestas, which make wind turbines, onshore wind turbines, and Siemens Gamesa, which make predominantly offshore wind turbines as well. Why is this happening? Obviously, we need to decarbonise, as Nick showed earlier, but also it actually makes economic sense as well. So if we flick over here onto the right-hand side, you can actually see the cost of wind and solar is actually below fossil fuels. It has come below fossil fuels now over the last decade. Obviously, if we roll this forward again, the actual cost of fossil fuels is going up, particularly obviously gas with what we're seeing in the world today. So it actually makes economic sense as well as sense in terms of decarbonising the planet. So that's going to continue to drive the growth of these companies going forward. Just on the next slide, we actually just have a case study here. This is NextEra. As mentioned, this is the biggest developer of solar and wind assets in the world. It's an American company. It's actually a very, very large company. But we just have our 5 tests of how we score the rating that the valuation multiple that this company should trade at. We think the company has very strong growth prospects, at least 10% growth prospects for at least the next couple of decades. it's very sustainable growth, i.e. this trend from fossil fuels to renewables is going to take a long period of time. And so it's very much a long-term opportunity. It's not an opportunity that's here this year and not next year. It's very much got at least a 5-year structural growth runway ahead of it. The control score, this is a method that we use to try to pick the best positioned company within the sector. This one scores a 3 out of 5. It doesn't score as highly as some of our other investments because it's a professional management team, not a founder-led company now, but still good alignment with us as shareholders. And then the last score there is a customer perception score. And so the customers that use this company are happy because they provide a very reliable service and a clean energy service as well there. So all up, we think this stock should trade at a high teens EV to EBITDA multiple. That's a little bit more expensive than the market, but we think that's justified in that the company should be growing double digits for a very, very long period of time, as I mentioned. So that's NextEra, which is one of our major stocks in the clean energy sleeve of the fund at the moment. I'll hand over to Nick for the clean transport.
Yeah, and so maybe so that's sort of the clean energy opportunity, and one of the stocks is in the fund. I'm going to talk just quickly about clean transport, which is I suppose the stuff that everyone's quite excited about at the moment. And for us, clean transport honestly sets up a lot like smartphones did back in 2008. We could have shown you this slide for Apple when we were investing in Apple in 2009 and 2010. The reality is we sell roughly 90 million cars in the world today. We'll probably sell 90 million cars 5 years from now, and we sold 90 million cars 5 years prior to that, the same as mobile phones were back then. But electric cars are clearly going to take share, and that inflection is happening right now. We are finally at the point where electric cars, again, as James flagged earlier, that the technology is good enough for people. The range anxiety things are being sold, and people are happy to buy electric cars at the moment because it is quite simply a better alternative. From that point of view, we think the biggest opportunity in electric cars is in the supply chain. Obviously, you can invest in Tesla, you can invest in some of the other Tesla wannabes, or you can invest in the weapons manufacturers in the war, i.e. in the supply chain, the bits that make these cars. And for us, that's semiconductors. Your standard internal combustion engine has roughly $375 semiconductor content. Your average electric vehicle has $750. Your average electric vehicle with any sort of autonomous capability has $1,600. And if anything, if you think about electric cars, previously a car would be all about its German engineering and how its engine works. Is it a V8? Is it a V12? That's how you get it to go fast. If you want an electric car to go fast, you've got to put some muscle in it, and the muscle is all semiconductors now. It is all power semis. Power semis are what take power and turn it into movement, into torque. And so from our point of view, the power semi companies look the most interesting. Just to really talk about that inflection that's occurring right now, maybe just to debunk the theory that it's not going to happen. This just shows you a much more closer zoom on what's happening with electric cars around the world. And you can see here that European electric car penetration is roughly 30% of all new vehicles today are electric or plug-in hybrids. And that's more than doubled from a year ago. China is exactly the same. The US has clearly not reached that inflection point yet, nor has Australia, partly to do with the size of the countries and the distance that people want to travel, but ultimately we feel that inflection will happen. As this inflection kicks in, this is semiconductor content per car, it's going to grow structurally. You have effectively a market this is exactly what we love to look for, a market that used to be cyclical that's now become structural. And that structural growth is being massively underappreciated by the market. The company we like here, in fact, we like a number of companies here, but the company we like here is listed in the United States. It's called onsemi. It is a power semiconductor producer. A power semi is quite simply, as I said, something that turns power into movement and manages the heat around that. And so in theory, it doesn't just go into electric vehicles, it actually goes into renewable energy facilities, it goes into charging terminals, it goes into grid. So they have this huge content uplift story to happen as we move to electrify the economy. And then putting that back to the slide, or to the stock story, the interesting thing about this company, and unfortunately that multiple there is wrong, I'll have to fix that. But the interesting thing about this company is it is just effectively, and you see this quite often without our portfolio. The companies we are looking at are generally previously quite boring companies. onsemi was a commodity type semiconductor producer, as was Infineon in the same space. But as their products are now being used to drive bigger and bigger things, then they suddenly become these structural winners. And so this company actually trades, as you can see here, at just 18 times earnings. It's a market multiple company. It's a market multiple company with this wonderful opportunity in front of it. This is the earnings growth of the company. You can see it stepping up over the last couple of years. That earnings growth has been driven by that shift to electric that we talked about. And we expect that to continue for a decade. There'll be bumps along the road, but effectively a decade of structural earnings growth, and you only have to pay 18 times earnings for it. And we see this consistently through our Climate Leaders Fund today. A lot of companies that are generally, I know people generally, and I'm sure it's going to come up in the Q&A, which we're about to get to, people are going to want to talk about the exciting battery technology, or they're going to want to talk about, you know, the really exciting, mining companies that are out there. And we agree they're there. And we like those ideas, we do. But more often than not, we're finding established players whose market is completely transformed. That's the case for onsemi. That's the case for air conditioning companies. That's the case for utilities. And if anything, it's those companies that mathematically look the best opportunities to invest in today. And you see that very much feeding through the fund. But we have spoken now for half an hour. So what we might do now is throw it back to questions. That's a very brief introduction to who we are, what the fund does in terms of being able to prosecute the enabling the decarbonisation of the planet. We've shown you how we think about the universe that we're going to invest in, and we've shown you a couple of companies. And so if you do buy MCCL today, you are going to get exposure to those 15 to 25 companies that are in the fund. And what we might do now is let Taylor jump back in and give you free rein to ask us any questions, to go wherever you want to go. We've got lots of slides here. We've got lots of pictures. We can talk about pretty much every company in the fund. And so we're happy to go there. Thank you.
Thanks, guys. That was incredibly insightful. I have to admit, I have always been really interested in our climate thematic, so I'm very excited that it's now a standalone fund. Okay, so that is the end of the formal presentation, just like you said. So now it's to the fun part, the Q&A. But before we do, I'd like to introduce our responsible investment manager, Mike Harut. Hi, Mike.
Hi, Taylor.
Could you tell us a little bit about yourself?
Sure. So as you mentioned, I'm the responsible investment manager here at Munro Partners. I've recently joined and I report straight into Nick, so I'm part of the investment team. I've got 10 years of experience in ESG, or environmental, social and governance risks in investments, and how that sort of feeds into investments. My previous role was working for an association that advises the large Australian superannuation funds. And I've also worked in ESG at the Future Fund, which is obviously Australia's $250 billion sovereign wealth fund. So that's me. On the side, I suppose, I do some lecturing at the University of Melbourne on sustainable investments too. So yeah, 3 or 4 weeks a year doing that too.
Awesome. And seeing as we've heard from Nick and James, why don't we start off with a question for you, Mike? We've been receiving quite a few questions about ESG. So could you just tell us a bit of background in how Munro integrates ESG into the investment process? And then more broadly, where is Munro heading?
Sure. Thanks, Taylor. So I suppose briefly, just in terms of the current practice, I mean, I know we're talking about the climate fund today, but you know, the ESG integration is really the same for all of the funds. So the key to it is the integration into the multiples. So I think, you know, as both Nick and James talked about, the qualitative factors that go into it. So ESG is currently embedded into that. And so companies that perform better on ESG, you know, we're willing to pay a premium for, because we frankly think that they're better managers of these risks, and I guess on the downside, less likely to fail, I suppose, because of these issues. So Nick, if you just briefly go to the next slide, I'll just touch on, you know, where we're going around ESG. So on that slide there, the two leftmost pillars really describe how ESG impacts our investments and our investment process. And the third is more about our Munro Partners as a business itself, you know, what we're doing as a corporate citizen, and which I can touch on if needed. But to briefly jump back into the ESG integration piece, so the core pillar of it is this ESG score, which we're currently working through. So I mentioned that we incorporate ESG through these qualitative factors. Going forward, really the mechanism stays the same, but with, I think, a couple of key differences. So we will actually split out and create a distinct ESG score. And so there'll be, 6 factors in future. So not only will we do that, but we're actually changing how we do that. So rather than relying on external service providers to derive these scores, we've just agreed a new framework really for us to integrate ESG using the SASB framework. So this will actually involve the team, and it won't just be me, it'll be, it'll be Nick, it'll be James and the rest of the team going, I suppose, line by line at what are the material issues for each company, coming to a view directly on that, and then that then being incorporated into the multiple and therefore the price target that we are willing to pay. So we're rolling this out at the moment, and it'll be going live as a 6th factor in July. The other thing which I'll just briefly touch on here is around exclusions or negative screens. I know it's definitely part of the part of the practices around ESG. So we've recently agreed and will soon publish a policy around exclusions or negative screens. We've decided to use these quite sparingly, I suppose, which for reasons which I can go into if you like. But in terms of what the screens themselves will be, so they'll be around tobacco and controversial weapons and sanctions and the companies that really perform very poorly on ESG. So that will apply across all of the funds. And then for the Munro Climate Change Leaders Fund, we will, I mean, it sort of goes without saying, but we won't, we will exclude formally things like tar sands, thermal coal mining, and, with some wriggle room, oil and gas and fossil fuels based generation, where it's it's above a particular thresholds of revenue. The other thing I'll just briefly touch on is stewardship. So stewardship is not so much about how it impacts the investment decisions that we make, but it's about what do we do once we make those investment decisions. So there I'll just touch on engagement. So I think one of the really exciting things for me joining Munro Partners is, as an active manager, we're regularly in contact with these companies. And so I think we have a really strong opportunity to really try to influence those companies to improve how they manage risks around climate change or around diversity or whatever the issue may be. So we are currently tracking how we and engaging with these companies around ESG. But going forward, the plan is to actually set some specific goals around where we think the companies are not performing, and then engage with those companies specifically on those issues and target that too. Final really brief point back to the Climate Change Leaders Fund, which I know is the primary, the discussion for today. I think for me, what's really exciting about it is that, many investors to date have been focused on the high transition risk companies. So things like fossil fuel generators, miners, industrials that are really highly, high emitters, and really the investor pressure, as Nick mentioned, has been on reducing those emissions in those companies. But I think what's exciting here is that we're really focused on the other side of that coin, right? Around the opportunities and the companies that actually enable that. So I think that, both of these things are essential, and they are, there are some really fantastic companies in here who are actually making a really major impact on this issue of climate change and coming up with these solutions. So it's exciting to be part of that journey too. So yeah, thank you.
Fantastic. Okay, the next question is from Tom. Regarding valuations across the climate universe, how much of the growth do you think is currently priced in?
Yeah, I can take that one, and maybe I'll let James jump in with a number. So from our point of view, this actual fund trades at a discount to the market multiple today, or roughly in line. And so from that point of view, we don't, the most exciting thing about the climate opportunity versus, say, the technology opportunity is is technology. You know, when we first started buying Apple, it was like 15 times earnings, and everyone thought it was a device company. And now everyone understands these concepts around winner takes most. You know, these huge champions come along, and every new tech company we meet, they're great, but the valuations are really high on quite a lot of them. It doesn't mean they're not going to be great investments, but it is harder than it was, say, 15 years ago. When we look at climate today, there are a lot of those high multiple companies as well, and we have very few of them today. What we actually find is a lot of companies actually at reasonable multiples or even discounts to the market that have this huge structural opportunity in front of you. And let's just talk, I mean, very simply about air conditioning. You know, air conditioning, you know, HVAC equipment used to be a business that grew at GDP. And now when you speak to Trane Technologies, they say people don't ring us when something breaks anymore. They ring us because they're trying to lower their carbon footprint. It's a completely different conversation. And so from our point of view, every company in the fund today is profitable. There are no zero profit companies, and there's even no zero revenue companies. You can invest in those, and there are some we like. They're just not currently at the valuations we're happy to pay for them. But so at the moment, every company is profitable, and everyone is positive revenue. And if anything, the fund is trading at the market multiple. I'm pretty sure that's correct, James. Is that correct?
Yeah, that's right. Yeah, it's a good question. And I tried to sort of mention it earlier, but might just sort of touch on it again. Across these four areas, we do see that there are valuation differences between the four areas. So as Nick mentioned, that sort of energy efficiency, they're very much industrial companies, which tend to trade around about the market multiples. Some a little higher, some a little lower. The clean transport, there's a lot of pre-revenue, pre-profitability companies in there. And they're in the universe, but as Nick mentioned, we're not invested in them. We're really invested in profitable companies today that are still part of the thematic, that have really good runways ahead of them. Some of the lower value areas of the fund and the market in the climate universe are in the circular economy and clean energy side, because they're traditional companies that might be transitioning, as sort of Mike touched on as well. So, and as we sort of engage with them and as they go through that transition, we just have an opportunity to basically you get the market to basically price that into these stocks multiples as well. So, so yeah, there's a real mix of valuations and mature businesses with also some exciting sort of less mature businesses, but all of them are profitable today.
Quite a few questions coming through, so thank you to our audience. Please keep them coming. Are technology companies part of the climate portfolio, and what percentage is considered unprofitable tech?
Yeah, so at the moment, there are obviously technologies. We look anywhere in the world in the climate portfolio, so we don't really mind what sector they're in. We're just really saying, can they prosecute one of these opportunities? Clearly, the semiconductor companies are technology companies in theory that I talked about, but they are clearly benefiting from the climate opportunity. And so our view, a climate stock is a company where 50% of its revenues will come from products that enable the decarbonisation of the planet within the next 5 years. And so the semiconductor companies are tech companies, but they're very low multiple today, you know, 15 times earnings, 18 times earnings I showed you. There are other things, you know, you could, if you wanted to go buy QuantumScape or Plug Power or Rivian or Lucid. Look, we like these companies. We think they're prosecuting a great opportunity. We just don't like the valuations today. And so we've looked at them, we like them, and at some point we would invest in them. But what you won't see in this fund, to be clear, it is, and may as well be really clear about this today, it is not, you know, a pure ESG fund. It is a thematic fund prosecuting the decarbonisation opportunity. And so most ESG funds you look at, you'll sit there and see Microsoft as the biggest position. Microsoft's the biggest position because it's a technology company, because it's a really good ESG company. Why is it a good ESG company? Because it makes software, it doesn't make anything. And so from that point of view, we like Microsoft too. We think it's great. It's actually the biggest position in the main fund today, but it's not in the climate fund because it's not doing that key thing that we're looking for, which is enabling the decarbonisation of the planet. We're really trying to drill down on those companies that are going to enable this opportunity, because that's going to give them the earnings growth. That earnings growth will give them the share price growth, and that'll drive the fund performance well into the future.
In the US, Biden recommitted to the clean energy bill in the State of the Union. What are your thoughts on the likely progress of the bill?
You want to take that one, James?
Yeah, okay. Look, not great, to be honest. The Build Back Better obviously has failed. It didn't get through, obviously, Joe Manchin there. So it looks like that's not going to get through now, and they're probably running out of time. But regardless of that would have been a nice accelerant for things like offshore wind, onshore wind, solar, batteries, hydrogen, etc. Maybe Nick, I'm just thinking of the right page to put this on. But yeah, I mean, the 4 quadrants would have been fine. It would have, accelerated some of these areas of growth. But regardless, this is happening anyway, as Nick mentioned. Companies like Munro have to reduce, we have to reduce as part of our commitments, our footprint. We need to invest in the technologies in our office to make this office run more efficiently. So that's engaging with companies like Siemens and Schneider there that you see in the top right-hand corner. Companies like Apple have to lower their footprint of not just their own manufacturing bases and their own offices, but also their suppliers as well. So they go to their suppliers in Taiwan and they say, hey, go and source some renewable power. So then to go to companies like Ørsted in that top left-hand corner there as well. Companies need to reduce their waste footprint. Companies like Coca-Cola, Pepsi, Nestle, etc. They have goals of recycling plastic, how much plastic they recycle, and those goals are 2025 goals, 2030 goals, etc. Or they need to shift to aluminium, which is Ball Corp, and they need to use companies like Tomra to get that plastic recycled as well. So all of this is going to happen anyway. Some policy from the government in the US would have been helpful, but it's still going to continue on.
And then for perspective, how important or large is this in comparison to Europe's historical initiatives?
Yeah, it's a good point. Europe has a whole bunch of different initiatives, and it's really moving very quickly in Europe. And part of this is obviously geopolitical as well, which we haven't really touched on yet. But we could probably do that now. So Germany, for example, is going to pull forward a lot of this spending. So they had sort of 2035 goals. They're going to increase those goals in terms of how much renewable power they use, as an example. Because obviously they're using, over 50% of their gas is sourced from Russia at the moment. So they need to accelerate the spend on renewables. France has got programs in place where they're encouraging, the European Union's got programs in place where they're encouraging people to retrofit the buildings quicker. So get the renovation cycle happening quicker. So that's positive for companies like Saint-Gobain, Kingspan, etc. on that top right-hand corner. Nick was saying the other day that in the UK, they've got new laws when they sell a house. When you sell a house, the minimum energy ratings of those houses. So it's going to drive demand for things like replacement heating products, etc. So there's a whole bunch of different policies in Europe, and it's moving very quickly. I think there's going to be a new draft out on the 11th of March or something like that. So you're going to see more come down the pipe there. Obviously, there's government changes as well. Germany's a big country within Europe, obviously, and the new government's obviously set new targets as well. So I think they're 50% larger than the previous targets in terms of renewable development. So there's a lot happening all the time, basically.
So we've just discussed the US and Europe. We've had a few questions regarding potential Australian climate winners. We currently have zero exposure to ASX listed companies. Why is that? And are there future Australian champions?
So from our point of view, obviously government policy helps create great champions. The biggest wind turbine manufacturer is in Denmark. The biggest electric car manufacturer is in California. That's not a coincidence. Both those states have fostered, a large industry for a long period of time. And so Australia is definitely playing catch up from that point of view. In terms of the Australian investments that would make sense, are obviously resources. Nickel is clearly the most exciting commodity in the space, as is lithium close behind that. I think most people on the webinar would be across this and look at some of those investments. We definitely looked at some of those. We haven't invested today. We can also obviously invest in these companies offshore through like Albemarle and in the US and others. So it's important to stress that it is a global fund. The idea is that, yes, there might be great opportunities in Australia, but if you take a broader global view, you'll find better opportunities. That's generally what happens when you're trying to prosecute an opportunity like this. And our theory is you'll be inundated by all these great companies who claim they can solve the decarbonisation agenda, or you can buy MCCL and we'll pick the best 15 to 25 on the whole planet for you. And that's essentially what you're paying us to do. And right now, but there isn't one in Australia that's piqued our interest. There's a couple we've looked at, but none in the fund today.
Wonderful. There's been some interest from the audience regarding the mechanics of the Munro Climate Change Leaders Fund. For instance, number of holdings, currency hedging. Can you perhaps just run through a summary?
Yep. Okay. So importantly, it's 15 to 25 names across those 4 subsectors. So at the moment, I think the fund has 21 names in it. It will always be fully invested, so it can hold cash, but only up to 10%. It will be unhedged, so the currency exposure that we get by buying companies in Denmark or the US, will be part of the fund, but we generally invest in developed markets. I saw some questions about China there. It's not a place we're investing in today. And the last thing, just to be clear, the quoted product on the exchange the quoted product is a managed ETF. So it will always trade at NAV. There is a market maker there, so it's not an LIC. It won't go to a discount. It will always trade at what the NAV is of the business. And so quite simply, you can wake up one day, you can buy the fund today, and tomorrow you'll wake up owning positions in all these great companies. And the day you don't want to own it anymore, you just go back to the ASX and you sell it and come back some other time. But from our point of view, we'll be fully invested in this opportunity the whole way. We will not be trying to manage the volatility too much. It is just a long-only decarbonisation portfolio of companies that enable the decarbonisation of the planet.
And what is the role of hydrogen within the clean energy opportunity set?
Yeah, I'll talk about that quickly. Hydrogen is a great opportunity. It is a slightly further out opportunity. It's important to stress that, there are lots of different types of hydrogen, grey, blue or green, but most of them ultimately drive off renewable energy. So you need the renewable energy first to make the cheap enough clean hydrogen. So we do like hydrogen, but it's definitely beyond a 2025 opportunity. And we find the market is probably not really prepared to pay for it today. And so we have looked at a number of companies here, particularly industrial gas companies like Linde or Air Products in the US. But for now, it's probably a little bit too far out from our point of view, so not in the fund today.
Wonderful. I think just noting the time, we might wrap up our questions there. Do you guys have any last thoughts you'd like to add?
Yeah, so the one thing I just wanted to add at the end, and maybe just to drive this point home. So we talked about the fund, we talked about the code, it's even on our backgrounds. But just to remind everybody, the reality is this product, it's not an ESG product. It's a thematic product of companies that will enable the decarbonisation of the planet. We clearly are looking at ESG principles. We look at ESG across all our funds. It's very important to us. Mike spoke about that. But in this product, we are, as Mike said, taking the positive side of the equation. The reality is in this business, I've been doing this for a long time. It's always the same. You're trying to find great management teams that are solving big problems. And when you find those management teams that solve those problems, you find earnings growth, and that earnings growth equals share price growth. From our point of view, these are some of the companies in the fund today, and all of them are effectively solving the CO2 problem. They're solving it either through insulation, through recycling, through smart switches, or through electric cars. And so our fund massively over indexes to climate solutions if you compare it to any benchmark. And then the last thing I'll say really clearly is don't think this is mutually exclusive to making money. The reality is that this is a great slide that just shows Tesla. And I think Tesla is the message I hope I probably leave everybody with here today. This is Tesla. This is its share price. This is the amount of capital that it's raised over the journey. Our job as your climate leaders investors is you allocate capital to us, and we allocate capital to the people that we think can solve these problems. And when they solve these problems, like Tesla did, Tesla raised more than $20 billion in capital from its investors over the journey. It helped it accelerate the development of electric cars. Electric cars then were required. They proved they were better and have taken a huge lead on the marketplace, and ultimately rewarded their shareholders, rewarded themselves, and rewarded their investors, and of course, brought forward the development of electric cars by more than a decade. And so from that point of view, money that's allocated to this product, we will allocate it to the management teams that we think are solving these problems in the most responsible way. If they do solve these problems in the most responsible way, that will equal earnings growth. That earnings growth will equal share price growth. And that share price growth will ultimately drive the returns of this fund. And so that's why we're so excited about this opportunity. I said at the start, It's still the case today. And please do use our website or any of our materials to update yourself further. And I can't wait to be continuing to do webinars about this for a decade to come as this opportunity evolves over the next decade. I think it's going to be really exciting.
As Nick mentioned, if you'd like to learn more about any of the themes spoken about today, we have a number of climate-related resources on our website. We also hope to bring you more ESG content later in the year, so please stay tuned for that. But in the meantime, a recording of this webinar will be available within the next 24 hours. Thank you again for taking the time to dial in with us today. And also on behalf of the team at Munro Partners, thank you for your ongoing support. Have a great day.
Thank you.